Hey everybody. This is going to be a very new format for me. This is the first time I'm attempting something like this using my monitor and a screen. So I hope that this works out and I find that I've recorded this well before I waste too much more time. So I thought this was good. This would be a very interesting topic because I've been following finance for a while and personal finance for a while, especially in the past 5 to 6 years when I became more focused on personal finance and actually since retirement was becoming more and more of a likelihood in my life. So I'm 55 and I'm planning to retire abroad. I am abroad. I live abroad. I've been working abroad for the past 30 years. And the my work situation and work conditions in the last 5 years caused me to look to look more closer at retirement because I saw that it was becoming more of a reality and more of a desire to possibly retire early. Um, I've been following a lot of personal finance people. They're not necessarily experts online, but they do offer a lot of experience and a lot of information on how uh, they retired, what their weaknesses were, what their strengths were, what their fears were, and most of the people I've been following have uh, have already retired. I'm not retired yet, but I am transitioning into retirement. 5 years, like I said, 5 years ago, I took it more seriously. Unfortunately, I'm starting relatively late. If I would have known what I had known even at least 15 years ago, I'd be in a much different financial circumstance. I wouldn't be as nervous as I am about it now. I'm not I'm not scared, but I'm not I'm not retiring with millions. I don't even have a million. So I have less than a million. I'm not going to give a specific number, but it's a less than a million, and it's something that I'm going to have to be very careful with. Otherwise, I could run out of money unless I find another work solution. So at the beginning of the year, so over the years, I started to find who was actually giving me very good. This I was listening more to people who were giving very good, solid advice. People who actually retired in their mid 50s. Some of them obviously are very well set, and they have a large cash reserve, and they leave a large portion of their investments grow. And many of the others are managing with 500,000 dollars on average from the ones that I watch. There's a few that are retired on less than that. They're a little older than I am, and but most of them seem to have between 500,000 and a million, which is roughly where I'm at. So one of the guys that I follow, I won't give any names yet, but he highly recommends getting a financial advisor to uh, review review your account, because you don't know what you don't know, and if you don't know something, it could get you in trouble, and it probably will get you in trouble. Uh, I tend to be a little more conservative, but I'm off, so I can tend to be a little more optimistic with on how things will pan out. And I've been wrong probably more times than not over the past couple years. I've made many mistakes with investments, and this is something I can't afford to make any mistakes with. So I decided to take his advice. He did give some recommendations on who to use, and I took his offer up. I contacted these two firms on the side. They're two independent firms. The reason I did it, one, it was paid, so I paid $350 for these guys to review my circumstances, and and the other ones were not paid. and I think they were more soliciting their services for future possible work than what than the paid version. So the paid, so the firm that I paid, it was $350 to review my circumstances, my portfolio, and my dreams, or my vision for retirement, and the other one was just kind of reviewing my portfolio and then basically listening to their sales pitch on what they have to offer, since it basically was a free review. So what I thought would be interesting here is the other circumstances behind when I did book um, these interviews was with the first group. They did review my portfolio back in March. So this was basically after Trump became president and his administration was in power for about a month. There was a bull run on the stock market, and the market went to all-time highs. And then after tariffs were starting to become more of a reality, the market started to pull back, and it basically went into a massive, pretty good correction by the beginning of April. So these guys reviewed my portfolio in the beginning of March, or the middle of March. The second group reviewed my portfolio based on the same numbers, but after the market had already rebounded in April. So what I thought I would do is I'm going to show you the report that these guys gave me, and I'm going to just pick out some of the highlights that they made in their review of my report. So I had sent them all of my information. I'd sent them my portfolio, sent them all my questions and all the questions I would have for them, and questions I had about my retirement. And one of the biggest questions I had was around health insurance, because again, this was in March when I didn't know I would be going into early retirement. This was when this was around the time that I was expecting that I might lose my job at the end of the year due to major budget cuts. And what's actually happened is true. I will be losing my job at the end of the year. So this was very good timing for me to be doing this. To do this review, although my circumstances has changed somewhat, in the one, because I will be losing my job at the end of the year, but the stock market has considerably rebounded since these guys did this review. Nonetheless, I think the highlights are worth making making a point. I think it's worth making a point about the highlights from this report. But I thought I'd just give you another statistics on why people don't use financial advisors. And this was definitely the case for me. I was hesitant to use financial advisors because usually the ones that I'm aware of, they're always trying to sell you something. They've got the hidden agenda. And the reason I went with these guys is because it was a one-off. There's no hidden agenda. They do offer services, and they will tell you they can support you further, but that wasn't the point of this, and this is what I really appreciated about these. But why don't people use financial advisors? Some of the statistics are 1 in 4 Americans don't use them because they don't trust them. They think that there's going to be an ulterior motive behind what's being recommended. And that was the case for me. And they basically don't trust other people with their money. It's hard to believe that, imagine that in many cases, younger guys in this profession, what do they, when you're looking at someone my age, looking down at someone who's giving me a financial advice, and they're 20, 30 years younger than me, you can tend to look down upon them and what their advice might be. I'm like, so what are you going to tell me about my money? But the difference is they're educated in personal finance and investment. I'm not. I am in the finance field, but I was never taught personal finance. I had to learn it all on my own. These guys are professionally trained in personal finance and to be a financial advisor. So just to also preface this video, this might go a little long, but I'll try to keep it as short as possible. But I find this very interesting, and I would have loved to learn from someone else who went through this process, just to give me a little more reassurance on using a financial advisor who isn't tied to any financial product. So, so some of the here are 5 questions that you can ask a financial advisor if you are interested in pursuing this. First of all, who is your typical client? Is it the normal Mary Jo and Jane, or do you only cater to millionaires or people with a substantial amount of money? 2, how do you get paid? Are you one off, or are you tied to selling me something to earn a commission? If they can't answer that, that's a red flag. And back to the first question, if their typical client is someone who's got millions to manage, they might not be able to relate to you. So it's got to be someone who can deal with middle aged average Joe Schmo who's a middle aged middle income earner, maybe not someone in the millions. So the third question is, what does your planning process actually look like? So the best advisors will have a repeatable process. It won't be a not one size fit all. They will be able to customize their review and their recommendations to your situation. And what not to do. So good advisors are normally clear on what they do and what they don't do. That's number 4. And number 5 is, how often do you reach out with proactive planning ideas? So good advisors can usually predict questions and offer questions, not just wait back for you to answer questions. They're just not waiting for you to answer questions. They're preempting what your concerns might be. So if they can articulate those questions back to you to make you feel comfortable, it might be worth something pursuing. So I'm going to share my screen here. I'm going to share the report that I was given. I did print up a copy, but I'm going to refer to my notes and the actual report that they gave me. As you can see, this particular group was defining wealth. And I'm crossing out some personal information. So in this assessment, they give you a nice little first page introduction. They thank you for your time. They give their names, a nice picture of them, two good-looking young, strapping young men, looking professional and very sport-fitted jackets. I did speak to both of these guys, and I can tell you that they were very enjoyable and very personable, and I really did appreciate what they had to offer, and they were as genuine as they did look on this photo. So I would highly recommend these guys just based on that. So just coming to my my intro executive summary. So this first section, they are essentially laying out the your summary of the situation, just to make sure that we're all on the same page. So I just highlighted a few points here. So my basic monthly need, I increased it a little bit to 2,500 to 3,000 to cover all my basic needs. This is a little higher than I think I would actually need. I think my actual need would be between 2,000. I think I'm budgeting my actual need to be between 2,000 to 2,500 minimum. That's my baseline. But I bumped it up because I just wanted to see how far I could push my projections. Anything over 2,500, I would love. That would basically be flexible income for me. But I just want to make sure I'm able to cover my basic expenses. That's and that doesn't include rent because I don't pay rent. I own the house where I live in Laos. It's a very small house. Taxes and everything are relatively small. So this is basically living comfortably with food and all the utilities, covering my costs, covering any kind of health insurance I might need that I'm going to need. And at the time that I did this, I didn't know what my health insurance estimates would be. I have them now, and they're going to be roughly between $400 to $500 a month. So that does fit into this minimum baseline expenditure that I'm expecting of about 2,000 to 2,500. This will include food. This will include all the utilities, telephone, um, uh, gas, fuel, probably a gym membership for my wife and I, and yeah, that's that telephone. I think I said that internet and that type of thing. Maybe in another video I'll break down my baseline expenses. So my ideal monthly cost or my ideal monthly budget would be $4,000 a month. But I could get by on up to $3,000 a month. And so up to $4,000 a month would include some light travel, and that would be the average for the year. Maybe a one trip a year, my wife and I to the beach or something like that. So this current plan of success, they have it down at 83%, as a 83% success rate based on this amount against my portfolio. So some of these other recommendations that they make in here are that they think that I should consider backing my assumptions down to 8 to 9% because my investments are all stocks. I'm 100% equity in ETFs. So I don't have bonds or anything like I don't have treasuries or anything like that. I'm 100%. I am also self-managed. I manage my own portfolio. And my expectation was 12%, and they are their first recommendation is for me to back my rate of return back to 8 to 9%. Especially if I'm holding 100% stocks. I think that 8 to 9% is a little low as an average based with the stocks that I'm holding, but it's definitely something to consider. In their second recommendation is mentioned above, the ideal spending and lowest acceptable spending goals, and are to test success of each of them to set guardrails using the Monte Carlo analysis. So one other thing that I forgot that I mentioned was I also use a software called Bolden, and that also is helping me monitor and plan my retirement on to check out my success rate based on my assumptions. But I won't use that. They use another software. I'm not sure exactly what they said they use, but basically they're giving me some guardrails to manage my plan in, so that if I say that I need 2,500, I need a little buffer maybe to $2,000 a month up to $3,000 a month. Those would be my guardrails on what I could spend, and I could be flexible depending on what happens in the market. So I hope that made sense. So they also another recommendation is they say plan to delay Social Security to at least my mid 60s, at least until 67. This because your benefits increase 8% each year every year that they are deferred. The survival benefits would increase due to this delay as well. So in my assumptions, I've been deliberating on delaying Social Security to 67 or start taking it at 62. I say quite frankly, I'm not convinced that Social Security will be there for me in the next 7 years, and I'm not sure it will be there for me um, in the amount that I would be expecting. The other issue is, um, why wouldn't I take the money now and take Social Security earlier, and then allow my own personal investments to continue compounding. So if my need was $2,000, my baseline is $2,000, and Social Security from the start can pay me $1,000, then I would only need $1,000 from my own personal investments, and that would allow the other $1,000 I'm not using to continue to compound. So that is something that I have time to figure out. I think delaying Social Security is one of the most common recommendations, but I'm not convinced yet. But I have time to figure that out. So one of the other recommendations they have here is beyond the Monte Carlo analysis, use the spending guardrails to maximize spending over a lifetime. So that basically means starting with my withdrawal percentage of about 5 to 5.5%. They said start with a withdrawal ratio of 5 to 5.5%, and then if the withdrawal increased the withdrawal ratio by 15 to 20%, decrease. If your withdrawal percentage increases by 15 to 20% due to poor market performance, lower my spending by 10%. So decrease income from $48,000 to $43,000 a year. If your withdrawal percentage decreases by 15 to 20% due to strong market performance, increase my spending by 10%. This increase will increase my allowable expenditure for the year to go from 48,000 to 53,000. So really it depends on the market volatility for the year. So the other thing I'll add is I will be using a bucket system. So I plan to have 1 to 3 years worth of living expenses in cash starting next year, and then I plan to have the other portion of that in growth and ETFs. So that is so two of the tips that they share is set 2 targets, ideal versus minimum, and spending, which is what I already have. And say I like this idea of using the guardrails. If I overspend, I tighten. If I underspend, I can spend a little more. And then if my investments do pretty well, I'll loosen up. So this is pretty smart advice. So the next section. So part of the investment structure and strategy that we discussed with them is that I would be using a bucket system. So the idea is to have 3 to 4 years of anywhere from 2 to 4 years of cash reserves ready and saved. So that's to get through any kind of market volatility. So if 20%, so my current portfolio is 20% invested in ETFs, and I'm aiming for 50% over 5 years, maybe 100% in 10 years. So currently my portfolio in ETFs is about 20 to 25%. I want to increase that to 50% within the next couple years. The way my portfolio, I won't go into the stock details right now, the way my portfolio is set up is to take advantage of this AI and technology run that I'm predicting we will be in the next 5 to 10 years. So I don't want to lose any of that growth. I know it's risky, but it's a risk I'm willing to take at this point. And then in within the next 2 years, I'll probably start reducing some of that risk and moving some of that money. I'll be de-risking, taking some where my gains are, and moving them over to ETFs. So the strategy that they have here is, so again, cash balance. I should have 3 to 4 years of my basic expenses in a bank account, high yield savings account. I'm roughly 20 to 25% diversified into ETFs, and I'm working toward 50% over the next 5 years, and potentially up to 100% within the next 10 years. Because within 10 years, I don't want to be managing my portfolio the way I am. I might have a small portion of high growth or speculative, but by the time I'm 60, 65, I don't want to be playing with this, and I just want to have. By then, hopefully, my portfolio will have grown into something that I can basically be living off of dividends and just skimming off the froth, if you will. So the recommendations they have here, the first one I've already did. Consolidate my investments into one custodian. I did have my accounts spread out to different. I had some money in Webull. I had some money in Moomoo. I had some money in SoFi and Charles Schwab. So I consolidated everything down to Charles Schwab and SoFi. So those are my two main accounts, and I use either one of those accounts for different types of investments. Schwab being my largest. So dollar cost average. So the second recommendation of my portfolio, dollar cost average the cash from my remaining inheritance from my parents into the market. This is already done. I have a very small amount of cash available right now that I'm planning to deploy probably in September next month if the market does take a downfall. Keep my short-term bucket within 1 to 2 years of my desired spending. So here now they're back to saying keep cash worth 1 to 2 years. They did say keep 1 to 2 years worth of cash, roughly 72,000 in a high yield saving account. So that would be money markets and funds and probably high yield savings account. And then they said build your second medium term bucket, 2 to 3 years of fixed income to insulate the portfolio even further from any kind of prolonged stock market turndown. So this would be an additional $100,000, so anywhere from 1 to 3 years of my basic living needs that I'd be putting into another bucket of bonds, fixed income, and treasury funds. So something that can yield me 3.5 to 4.5%. There's another. I won't, without going into a rabbit trail. I watch another guy who does statistics, and based on historical trending of the stock market, and the stock market in the past has gone. We've had the Great Depression, we've had some recessions that have lasted for a couple years, but generally speaking, the history doesn't predict the future, but it does. There's enough evidence there to say you don't want to ignore history because history does repeat itself. But they do say that recessions the length of recessions have lasted shorter and shorter periods of time. I think one of the longest ones was 3 to 5 years during the Great Depression, and then it took a long time for the stock market to recover. But more recently, in the last 50 years, that's not necessarily the case. So generally, stock markets have recovered more on average within 1 to 2 years, and that I think that's even pushing it. So to think about a market that hasn't um, to think about a recession or a market that is on a pullback or in a bear market for more than a year is quite unusual. And with the growth rate of big companies these days, it's different. The type of companies, the way these companies are making money, it's different than it was in during the 40s, 50s, 60s, 70s, and 80s. I could be wrong, but yeah, these guys definitely have to take a little more of a more conservative route. So the remainder of your assets, on to the next recommendation. The remainder of your assets should be positioned in stocks and ETFs, and they suggest our market portfolio is benched at 70% stock, U.S. stocks, and 30% international. Um, I don't agree with that. I think many of the stocks that I'm holding are exposed internationally, even though they might be U.S. and Western based. I have about four companies. I own about four companies who are 100% international, um, but I don't think I need 30 international. The international market has historically not performed as well as the U.S. stock market. Warren Buffett has always said, "Don't bet against the U.S. economy." That doesn't mean things can change, but I think I don't agree with this recommendation. So I'm going to keep things as they are, and because I think I have enough exposure internationally with the stocks that I have, and this kind of lines up with the other recommendation, the other firm that gave me a recommendation. They also recommend looking at owning small and medium-sized companies, which is what I do. I do have investments, a very small bucket of speculative investments in the more investments in more speculative stocks. So I plan, and that's basically where I'm hoping to get more growth. So the executive summary, moving on. So let's move down to where I have some highlights. They said create your monthly paycheck in retirement. Practice systematic rebalancing at least quarterly. Each quarter you will sell what has gone up and move to the cash that can be sent to you in your bank account or monthly or biweekly, however quickly or however often I monitor. So right now I monitor weekly, probably more than I should, but I do want to move. As I move into retirement, I'll probably have more time, and I'll be able to invest more time on short periods of. I'll be able to invest more focused time in very short periods of time, so that I don't have to be monitoring my portfolio weekly, even weekly. I want to move it to bi-monthly or even quarterly, as this is because the stock market. I don't need to follow the stock market on a daily basis. I just need to follow earnings reports from companies that I own, and then watch to see what has happened with those companies. Because I don't want my time spent doing this. I want my free time, my retirement time spent doing things of quality. I do like to manage my portfolio, but I don't want this to be a full-time job. So tax planning recommendations. They say, since I'll be filing single, my wife is not a U.S. citizen. So the recommendation was that I don't try to get her any kind of Social Security number. We don't have any plans to go back to the U.S. So they think it's more advantageous for me to continue filing single. Continue understanding tax implications of withdrawals and maximizing tax efficiency. I think that as of right now, I can withdraw up to roughly $50,000 a year. I can take gains on my stock portfolio without being exposed to moving into the next tax bracket. So if I want to stay within that 12% 12 to 20% tax bracket, I think I need to withdraw less than $50,000 a year. And that's manageable for me to move forward, to keep my taxes as low as possible, and to also store, keep storing up my cash reserves for that first bucket. So here another recommendation: max out my Roth IRA. This is something that I didn't take advantage of over the years as much as I should have. Part of that has to do with my income. The problem I had is my income earned was always overseas, so I couldn't contribute to my Roth. Unfortunately, the tax consultant that I used, I had asked her about doing a backdoor Roth many years ago, and she said I can't do it, and I didn't really fully understand it. There's many more videos out about it now that I realized I could have been using a backdoor Roth all these years, and she only confirmed it within the past 2 years that I can use a backdoor Roth conversion. And I could have taken advantage of this, and I'm really miffed about it because I lost that opportunity after all those years. And she was a tax consultant. I still use her. She's relatively inexpensive, but maybe I get what I pay for. But I'm really miffed about that because I lost many years that I could have done this, and I think it cost me some to be in a better position with my Roth. But as of next year, I might not be able to contribute to my Roth if I don't have any extra income. I will try to work if I can, small consultancies. I will try to earn a little extra money if I can, if I have opportunities. So then if I do that, I can take advantage of the Roth moving forward next year. So I maxed that out as far as I can this year, and then hopefully next year I might have more opportunity. So the next recommendation is to keep my Roth in stocks so that they can compound they can compound tax free. Right now my Roth is all equities, and they're in 8 stocks. I'm pretty concentrated, but they're in high growth, very mature stocks that I believe will still beat the S&P 500 at least over the next 5 years. I will reevaluate that in the next couple years to see if and maybe take some gains off of that table and move them into ETFs. So I'm okay with I'm in that position, a decent position with my Roth. Not as far as amount wise, but at least as far as the recommendation is concerned. So that confirmed what I'm doing there with my Roth. And then the next one is review opportunities to tax loss harvest. This is basically where you can tax loss harvest capital losses over the years. You can tax loss harvest up to $3,000 a year. Most of my stocks are in the long-term bucket, so I won't really have much of that. This year I might take advantage of some of that to reduce some tax liabilities. But yeah, the longer I hold my stocks, the less that I can take advantage of this. So I think that's it for that recommendation. So in summary here, so this is about health insurance. I won't spend any time on this. Spend much time on this. They did give me a recommendation for a company for an agent to look up, and I did speak with him, and he did give me some options that I'm looking into for inpatient for my wife and I. It is since I will have to be paying for that myself, at least probably indefinitely, I suppose. I don't think it's worth it for outpatient because my wife and I were pretty healthy, so all the dental, all the pharmacy, all the medical checkups and things, they're all going to be out of pocket. Um, so the recommendation for a guy to look up as far as Asian is concerned, that worked out very well. So I'm thankful to them for that. So estate planning. So my sister will be my executress when I pass. All of my everything will go to my wife. The problem is she's in Asia and my sister is in the U.S. My sister is not a my sister or no one in my family would be able to manage my portfolio. So one of the things that I'm looking so this recommendation he has here is to look up legal protection for my wife. I do have my I do have myself set up as an estate, so that if something does happen to me, my estate would go to my wife, but under the management of my sister. So I will manage my portfolio as long as I am alive and as long as I want. But this is something that I probably will have in my will that if something does happen to me, I will have my recommendation that my assets go under management. So management for hire. So and it would likely be with this company and they charge 1% on of your portfolio. I think that's roughly what they're charging. So 1% on $500,000 would be $5,000 a year. 1% on a million would be $10,000 a year. As long as I can manage it, I'm not going to have that happen. But I think for the sake of my sister and my wife and everything, I think it would be worth that paying that fee to put all my portfolio under assets under management, and then this management company, this management firm would then make sure my wife has what she needs, and while trying to protect my portfolio to support her for as long as she lives. I hope that came out clear. So executive summary. So ensure. So see, these are the last few bits that they recommend. So they ensure you have proper beneficiaries listed on all my retirement accounts and any kind of policies, which I do. We recommend reviewing your core estate plan documents, wills, power of attorney, health directives. I did that a few years ago, the last time I was in the U.S. I will probably follow up with a lawyer again just to confirm that everything is okay. And then their last recommendation is consider a trust that is based in the U.S. to help simplify management of my assets for my wife's benefits. And that's what I will also probably do the next time I am home. God willing, I will be home to do that. So here, this is some other ways that they will support me. They do investment analysis, ongoing investment management, tax advantage investing. Here's a break, etc., etc. They do offer planning packages, so they will continue to do one-off planning or updates of my portfolio if I want. So I could probably pay them $350 again to look at my update portfolio since they already know it. They do offer long-term plans and more comprehensive plans. They just sent me an email about one. There's a year-long plan that they can offer for $3,000, and then there's another one that more of a engage a plan that where they stay engaged with you actively with quarterly meetings and updates to follow you and with the recommendations that they make to make sure that you don't have any questions. And this and they help you monitor your program or your plan for a year. They're much more active in it, and that's $3,500 a year, which I'm seriously considering to do. It sounds like a lot of money, but the amount of money that I could lose potentially, and this is my life, the rest of my life, and my wife's life savings, it's worth it. I think it's really worth it to get that professional extra set of eyes to 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 bounce ideas off of, and just to make sure I'm not living in a silo and putting myself just to make sure I'm covering all the possibilities and making educated guesses, because you don't want to go do this in ignorance. This is one thing. The one uh, YouTuber that I follow, he's been doing it for 6 years. Even he has, he says he has this his his brain trust, basically, of three people he trusts. One of them being a financial advisor. He checks in with regularly before he does anything major or anything that could be outside of the scope of his plan. So he's been doing this, and he's clearly got a lot of money, so he's very comfortable, and he still does this with a financial advisor. I think the less you have, the more critical it is that you have an extra set of eyes and an extra voice to make sure that you are managing yourself properly, and you're managing your plan and executing properly, because you don't want to mess this up if you're not in a very wealthy position. Whereas if you make a financial mistake, that could be catastrophic to the rest of your life, if you have 10, 20, 30 more years of remaining. And I couldn't afford to do that, even if I lived as long as I do. Even if I don't live as long as I do, as I'm planning, I'm planning to live up to 80, 85. The likelihood of me living to 90 is higher, but my father died at 80, and so I'm planning probably about 80, 85. But I just want to make sure my wife is well. If I die before then, before I'm 85, she will be well taken care of. Um, so I just kind of went off on a rabbit hole there. So this is what they charge. This is what they charge to manage portfolios. So 0 to 1.5 million is 1%. I think it's very reasonable, and they will try to adhere to your parameters, what you want for a portfolio. 1.5 to 3 million is 0.8%, and so on and so on. So the more money you have, the less it costs, in comparison to the previous range. So, yeah, here's their other plan where they do much more comprehensive plan. It's $300 a month or $3,600 a year. I will probably take advantage of that, but later in the year, closer to the end of the year when I get paid, and I have my final pay from work. Let me quick show you the. This is so that was the paid version, $350. I really recommend these guys. I thought they were great. And so this is the presentation I got from the second group. So the second group again was free. It was a 45-minute discussion. They reviewed my portfolio. I sent them all the questions of my portfolio beforehand. They did some analysis, and this is what they came up with. So most of this presentation is basically a marketing to get you to use their services. So they will compare my portfolio to their portfolio and against the S&P 500. So I won't go over all these charts. So this is probably one of the more interesting things that they did that the first group didn't do. They did a comparison of my portfolio against what their portfolio would look like. So you can see here, my portfolio is in blue, and their portfolio is in orange. I am mostly in North America. Most of my portfolio is in North America. I have a little bit in South America compared to what they have. I have a little bit in Western Europe compared to what they have, and I have a little bit in Southeast Asia or Asia Pacific compared to what they have. I have nothing else in the Middle East or Africa. You can see how I compared to what their benchmark is. And then coming down, here's the distribution by sector. So my my numbers are here compared to what theirs are. So in communication and services, I'm 7.920%. They have 4%, and they consider their portfolio moderately aggressive. I consider my portfolio moderately aggressive. So it's just a difference in perspective. Consumer discretionary, I have 23%. They have 10%. Consumer staples, I have 1%. They have 7%. Energy, I have less than 1%. They have 4%. Financials, I have 3. They have 14. Healthcare, I have 3. They have 11. Industrials, they have 8. I have 14. Informational technology, I have 52. They have 14. This is where I'm heavily weighted. Of course, I believe I'm more heavily weighted in the more technology stocks and companies, because I do think there's going to be a big push in the next couple years with AI and software. The microchips and semiconductors are the new oil, so I hear. Materials, 0.2%, they have 5%, and so on and so on. So very big difference in portfolio distribution compared to what mine is. Down here, this is not interesting. These aren't really worth commenting on. So that's really it. So the rest of this presentation is basically what they offer, how they differ compared to everybody else. And it ends with their pictures. They were nice guys. That's not a very flattering picture of the guy I spoke to. He was kind of like that, kind of not very emotionally. This guy was very nice. Anyway, they were more expensive as far as managing portfolio. But anyway, so that's all I have here on my financial plan. So so basically, what it comes down to in the end, their recommendations are back off 12% on my expectations. They recommend keeping my portfolio at 8 to 9% rate of return, expected rate of return. I think that's too low. I would consider 10 to 12, but I think 8 to 9% for my portfolio, I think it's too low, especially for the next few years. They say keep dollar cost averaging, review my estate plan, which is what I'll do, explore insurance and trust setup, which is what I already did both of those. And they said adjust investment buckets as I move closer to the date. So any of you, so what do you think of that? This is probably going to be very long. This is my first time doing something like this. So there's so much information in these, and just to give you a good background of where I'm coming from, it's going toward this review was done in March. It's going on September, and the market situation has changed. I'm going to probably do more videos like this in this format because I think it's easy. It's nice when you can see the numbers and see what people are talking about rather than just speaking to them into the screen. So thanks for joining me on this journey. What about you? Or have you used any financial advisors? If you have, can you share their names below? I'm considering a different, possibly using at least this financial advisor again. I'll probably be using, like I mentioned, I use Bolden software. There's a financial advisor that you can hire for $250 to review my Bolden software parameters. So I might do that. Sounds like I'm investing a lot in financial advisors, but I need to make sure that I don't see any holes in my plan. So if I need to use these guys again, and if I need to use them for another year, I need to be comfortable with what I'm doing because I've never done this before. And with the Bolden software, if I can get someone on the inside of the software to look through to see if I'm missing anything, um, to, to, to make sure my results are coming out the way they should, I'm going to do that. This is worth it to me because I can't mess this up. I don't have enough room to mess this up for my financial future. I trust God to lead and guide, but I also believe He brings people. He also has advisors there. You know, there's plenty of wisdom in Proverbs that says, "He who seeks out counsel is a wise man." And I need counsel because this is new territory for me, and this is for the rest of my life. So I really recommend you to consider this also. Yeah, let me know where you are in your plans for retirement or early retirement. Have you used an advisor? What 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 uh, what's what jumps out to you the most in this financial review? Do you think it was worth it? So I'm going to end that there, and hopefully that this wasn't too much of an incoherent ramble. Take care, everybody. God bless. This is Choice at Winding Down Chronicles of an Expat going into early retirement. I'm not retired yet, but as you can see, I'm getting there. And this is becoming more and more crucial and important that I get this right. I'm in the best position and most comfortable position as I can be since I am managing this on my own. Take care, everybody. God bless, and take it slow.